Good afternoon. This is Business Live with me, Ian King. Before we get down to the business news, there's been a bit of breaking news in the last few moments. The Secretary of State for the US, Antony Blinken, has been speaking about the release of 3 US citizens from Iran. Here we go. We can briefly hear what he's got to say.
A few minutes ago, I had the great pleasure of speaking to 7 Americans who are now free from their imprisonment or detention in Iran, out of prison, and now in Doha, en route back to the United States to be reunited with their loved ones. 5 of the 7, of course, had been unjustly detained, imprisoned in Iran, some for years. 2 others had been prevented from leaving Iran. I spoke to them after they landed in Doha. I can tell you that it was, for them, for me, an emotional conversation. It's easy in the work that we do every day sometimes to get lost in the abstractions of foreign policy and relations with other countries and forgetting the human element that's at the heart of everything we do. But today...
So there you go. That's the Secretary of State, Antony Blinken, revealing that 5 American citizens who had been imprisoned in Iran are on their way home. We do know from our previous reporting on the channel that there has been a payment released to the Iranian authorities in return for that. No doubt we'll have more on that throughout the evening here on Sky News. In the meantime, ministers say construction of HS2 is continuing in earnest, despite further doubt being cast over its future over the weekend when Downing Street refused to confirm that it would run to Manchester as planned. In the last hour, a question has been asked in the Commons on the planned route and delivery of HS2. The Transport Minister, Richard Holden, wouldn't be drawn on whether it would go as far as Manchester or not.
Construction continues in earnest with around 350 active construction sites, and we are getting on with delivery with high-speed rail services between London and Birmingham Curzon Street due to commence in 2033, with the rescope stages following. This will specifically drive regeneration of 1,600 acres, delivering 40,000 homes and supporting 65,000 jobs in outer London, and the benefits of HS2 for Birmingham are already being realised.
Well, joining me now is our business correspondent, Paul Kelso. Paul, I might be wrong, but that really didn't tell us anything we didn't know already.
No, and it certainly didn't answer the question. He went out of his way, in fact, to avoid answering the central question, which is HS2 ever going to get north of Birmingham? For that matter, is it going to get south and east of Old Oak Common in London, the London suburbs, where it's currently scheduled to terminate for the time being and may not get further than that? It's been in play, this question, since it was reported last week that the Chancellor and the Prime Minister are examining whether the costs have finally got too high on what has become a £100 billion project. The government's due to release the latest cost of HS2 adjusted for inflation. They're still running at 2019 numbers, so we can expect that figure to get very big indeed. Downing Street hasn't committed to going beyond Birmingham. Phase 1 of the project is building London to Birmingham. I spoke to Mark Harper, the Transport Secretary, directly this morning at a conference about the motoring trade. Different form of transport, but answer came there none from him. He said essentially the same: construction. We are working on phase 1, and you'd expect the Prime Minister and the Chancellor to look at this. If the government is going to announce this and want to do it to Parliament, they've got till tomorrow. It goes into recess. But we've just had that urgent question, which an answer didn't come. It's now not clear whether there will be any guidance on what happens to this project. If it doesn't run north of Birmingham, you already heard what those in the north, business, political leaders, and many people will think. We've already seen the Leeds leg of this project being binned by Grant Shapps and Boris Johnson. If the leg to Manchester goes as well, there will be certainly be taken the view that there is no genuine interest in improving transport in the north. It looks like we're going to have to wait and see what will happen to this project, which if we end up with around 100 miles from Birmingham to the London suburbs, I think the questions about value for money will get even louder.
OK, thanks, Paul. Now, the FTSE 100 life and savings giant Phoenix Group said today it's on the lookout for further takeover targets after completing its £250 million takeover of Sun Life of Canada's UK arm in April. The company, whose 14 million customers include former policyholders of names like Britannic, Pearl and Scottish Mutual, was reporting cash generation of £898 million for the 6 months to the end of June. That compared with £950 million in the same period last year. Well, Phoenix, which writes new policies under the Standard Life brand, also reported £3.1 billion worth of new business net fund flows, up 72% year on year. I've been speaking to Andy Briggs. He's the chief executive, and began by asking him what was driving that growth.
We've doubled our new business long-term cash. That's the future cash from new business. And the key driver of that has been the 72% growth in new business net fund flows. And there's basically two key drivers to that. One is our workplace pensions business, and the other is the BPA market.
And the key point here is that you've said today that for the first time next year, your new flows are going to offset what goes out the other way with the closed-end funds.
Exactly. So a few years ago, everyone would have looked at Phoenix Group as being a closed book consolidator. But when we bought the Standard Life business, we've invested heavily in that business. That's going superbly. That's the highlight of our results today, the organic growth. And it means that those new business net fund flows that are up 72% in the first half, that we expect next year, they will more than offset the runoff from the closed book, natural runoff and outflows from that closed book. So really, and it's a pivotal moment for Phoenix to be at the point where we've got that strong organic growth.
Do you think some investors might look at the business a bit more differently as a result?
I mean, I think it's attractive. We still run the in-force business really well. We had £412 million of management actions in the first half. We still do M&A, a core part of the strategy, and we've got the financing capacity and debt capacity to fund more M&A. We're optimistic about that going forward. But then adding on the organic growth through Standard Life, particularly the capital-light fee-based business. So we talked today about, we're the UK's largest long-term savings and retirement business. We have 270 billion of assets we look after for our 12 million customers. 2/3 of that is fee-based capital-light business, and that's where the workplace business and the retail business is growing, and that in particular is attractive to investors.
You've said today that you're still on the hunt for potential acquisitions. Are there many closed-end funds out there still coming onto the market?
So there's £435 billion of closed book assets in the UK market that we don't currently own. But there are a finite number of books, so we're really optimistic there will be opportunities going forward. What I can't predict is exactly which book of business and at which point in time. But what's interesting across the business as a whole, but if I relate specifically to the M&A side, is for most sectors, the current UK economic environment is quite challenging. Actually, it's accelerating the strong drivers of growth that are already in UK savings and retirement. So from an M&A perspective, the higher inflation, if you've got a closed book business, it runs off each year. You have to take your costs down each year in order to just stand still and continue to get the dividend. That's hard to do at the best of times. It's even harder in a higher inflation environment if you haven't hedged out that inflation risk. We hedge it out in our own book, but a lot of others don't. And so we think that's likely to bring more opportunities to market sooner.
Now, you referenced BPAs just now, bulk purchase annuities. You're in the hunt there for deals as well. But you said today you're not after the big blockbuster funds, the likes of BAE Systems, which recently did a buyout. Why is that?
Yeah, so what we like to do is keep a very balanced overall business mix. So I said a moment ago, 2/3 of our assets are capital-light fee-based. The annuities are only 13% of our total assets. So it's very profitable, attractive business, but we like to keep it to a finite proportion of our balance sheet because of the credit risk associated with it. Again, quite a lot of investors worry about the credit risk on BPA. So what we do is we basically allocate £300 million of capital a year to the BPA business. And we've done that the last couple of years, been very successful. We're making that ever more capital efficient, but we're trying to limit the risk in that area, whereas the capital-light fee-based business, you don't have those risks. It's capital-light, and we're looking to grow, faster still in those areas.
You've recently signed up to the Mansion House Accords. Are you managing new funds money differently from the closed-end money? Because essentially there you're trying to meet a liability that you know is going to come up at some point in the future. Can you be more imaginative with how you put the new funds to use?
Yeah, so the first thing I'd say is across the 3 trillion of pension assets in the UK market, only 9% is invested into productive assets, so things like private equity, private debt. You take the other 7 largest pensions nations globally, their equivalent to our 9% is 23%. And the way, if you take, for example, a defined contribution saver, what that means is the real returns in the UK for those savers over the last decade have been about 4%, and our Australian and Canadian counterparts have had 5.2 and 5.5%. So our focus in this area is purely driven by getting the best returns for our customers. So back to your specific question, we wouldn't draw a distinction between whether a product was closed or open. That wouldn't, you know, we're looking to meet the needs of our customers, whatever products they're in. We want to give them the best outcomes we possibly can. The distinction would be that in the workplace savings market or the legacy defined contribution type products, we do have a high equity content, and we'd like to put some of that into private equity. That's what the Mansion House Compact is all about. When it comes to the annuity business, the bulk purchase annuities, those are fixed liabilities. So we cash flow match those with debt type investments. But we like to do private debt in that space. That would be private debt though than private equity. So it's the type of product rather than whether it's open or closed.
But you would accept that the fund management industry in this country has been rather more conservative at times than it could be. I mean, that's what Mansion House is all about.
Yeah, so in the UK, as I say, we've only got 9% invested in these sorts of productive assets, which generally are higher returning. If you have a good diversified range of them, you get a higher return. And the other 7 largest pensions nations globally have 23%. So our customers are getting lower returns overall, lower outcomes overall as a result of that. And that's what we're looking to change through the Mansion House Compact.
Now, obviously, you're funding a think tank that puts out a lot of interesting research on pensions. What's your current thinking around the triple lock? There's obviously debate about whether the government should go through with the 8.5% rise next year.
Yeah, I think it's quite a complex area, and it is an area that Phoenix Insights, our think tank, have done and published some work in. So at the one end, you've got the benefit of simplicity of a simple state pension that's same for everybody. But the reality is you'll have some people that, for example, left school at 16 and worked in a heavily manual intensive role. And after they've done that for 40 odd years in their 50s, maybe they've had enough of that, yeah. Whereas you have others that might go through various stages of postgraduate further education and work in a more office-based role and can potentially work for longer. And so I think there's a trade-off balance between the simplicity of a basic state pension at a certain age, versus recognising that different people are on different journeys at different points in their lives. I think the other key point to bear in mind is there are an awful lot of people that rely entirely on the basic state pension for their income in retirement, and therefore it is important that for them it keeps pace with the cost of living.
That was Andy Briggs from Phoenix Group speaking to me earlier. I can tell you the shares have finished 2% lower. They are, however, up 2% on the last week. Some other news stories for you now. And the Competition and Markets Authority warned today that the boom in artificial intelligence could harm people and businesses if competition in the sector proved weak or if developers failed to heed consumer protection law. It said that, for example, people could be exposed to significant levels of false and misleading information and AI-enabled fraud, while longer term, a handful of firms could use AI systems to gain or entrench positions of market power and fail to offer the best products and services. However, setting out principles to ensure consumer protection and healthy competition with the development and use of such systems, the regulator said that applications like ChatGPT and Office 365 Copilot did have potential to spur innovation and economic growth. Pendragon, once the UK's biggest quoted car dealership, is selling its entire UK motor and leasing business for £250 million to the listed US motor dealer Lithia. The businesses changing hands include Evans Halshaw, Stratstone and Carstore. Lithia entered the UK market in March this year with the acquisition of Hong Kong-based Jardine Matheson's car dealership business, Jardine Motors. Well, following the sale, Pendragon will focus on Pinewood, its dealer management software business, which will be rolled out across Lithia's UK and US businesses. Pendragon shares have risen today by 27% on that news. The advertising mogul Sir Martin Sorrell has warned that fears of a recession are making clients spend more cautiously. His company S4 Capital accordingly cut its annual revenue forecast again today, causing the shares to hit an all-time low.
The bigger clients are probably still, particularly on digital. I mean, you've seen digital advertising up 8 or 9%. Analog is down 8 or 9%. If you have sports like Fox does or or Disney has, it protects it a little bit, but the upfronts don't sound as though they're very good in America. So analog advertising under pressure, digital remains. It's the smaller regional clients where we've seen the contraction.
Still to come here on Business Live. We'll have a look at how the markets have finished this Monday afternoon. Stay tuned.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Welcome back. A bit of breaking news for you concerning Russell Brand now. And this comes from the Theatre Royal in Windsor, which has just put out the following statement in which the promoters are cancelling some shows that he was going to do for charity. The statement reads, the management team would like to share the following statement from the promoters of Russell Brand's Bipolarisation Tour. We are postponing these few remaining addiction charity fundraiser shows. We don't like doing it, but we know you'll understand. Onto the markets now, and the oil price continues to grind higher on growing expectations of demand outstripping supply. This afternoon, Brent crude has hit $94.95 a barrel. That is the highest since the 15th of November last year. The price is currently $94.52, just under 2/3% higher on the session. On the equity markets, Europe has traded to the downside today. All of the main continental European indices in negative territory at the close. The big talking point today has been Société Générale, the third biggest French bank, has fallen by 13% after the new chief executive gave a strategic update in which he admitted he expects to see little growth in coming years. Here in London, the FTSE 100 similarly finishing the session in negative territory. That's a Soc Gen. Look at that, it's off 14.25% in the end. Pretty grim stuff there. The FTSE off 0.75%. Broad-based sell-off led by one or two of the financial stocks. The biggest blue chip fall in percentage terms is RS Group, the distributor. That's on broker comment. Meanwhile, among the gainers, the paper and packaging group Mondi finished ahead by some 3.25%. That's on news that it's exiting Russia, and it believes it can get the money out and give it to shareholders, which would be quite some achievement if it pulled that off. Outside the FTSE, Drax Group is the leading gainer. It sold off unexpectedly on Friday, but as you can see, it's clawed some of those losses back, up 3.75% on the session. Lower down the corporate food chain, the battery metals explorer Corsell, favourite one among private punters, that's jumped 11% after it secured a £10 million loan note financing agreement. Over on Wall Street, well, it's been a pretty subdued start to the session ahead of this Wednesday's interest rate decision. As you can see, the Nasdaq has crept up around 0.1% higher. Arm Holdings, of course, been keeping a very close eye on that one. It fell 6% on Friday evening. It's off another 5% today, but it still remains above the IPO price. Meanwhile, on the foreign exchange markets, well, again, it's been a bit subdued as we await the Fed's interest rate decision on Wednesday night. Pound up 0.1% against the dollar. It's off 0.25% against the euro. Well, joining me this afternoon is Chris Beecham. He's Chief Market Analyst at IG Group. Chris, good to see you this afternoon. The oil price just keeps hitting 10-month highs, doesn't it?
Yes, it does, and that's unnerving markets, really. I think they've begun to notice it over the past month. The fact that, as you say, we're back to the highest level we've seen since October and November last year. And I think this is really driving fears that inflation, the big bugbear of the last 2 years, is going to come back to haunt us and central banks over the next few months.
Do you think this is going to inform in any way the Fed's interest rate decision this week? Because obviously we got a blip upwards in the latest US inflation data.
Yeah, not this time around. I think, 1 month isn't a trend yet. But in November, when the next decision comes around, things could look very, very different. If you get 2-3 months of CPI figures increasing, the Fed is going to look at that and think, OK, there's no sign of oil turning lower. Inflation is once again coming back to really bite us. We're going to have to react to that. And that could, I think, push other central banks into moving as well. Really. This is the big fear for the autumn, that oil, which we thought was going to stay nice and quiet, is going to come back to haunt us.
Yeah, not great news for Rishi Sunak, who, of course, pledged to halve it this year.
No, it's going to spoil the plans for the government as well. And that's the problem, of course, if you make promises about things that aren't entirely in your control, it's going to come back to catch you out sometimes. And that's, I think, going to make life difficult for the government, of course, as we head into the election next year.
Would it be your expectation then, Chris? Obviously, we get the inflation data for the UK on Wednesday. Would you expect to see a blip upwards in August as well?
Yes, I think we'll see what we saw in the US data. Of course, the UK inflation rate's running above the US and hasn't really turned lower in that meaningful way that the US has. So that piles the pressure on the Bank of England as well. They probably will hike again this week as well. And then, of course, they know we've had Andrew Bailey saying we're probably done with hiking or close to the end, but that could upset things as well, really. So oil, the big problem in the last 2 years is just really coming back again to make investors worry about the future heading into 2024.
Now, we talked an awful lot about Arm Holdings over the last week or so. It's not had a great 48 hours on the market.
No, I mean, understandably with IPOs, once the initial froth dissipates, and it does dissipate rather quickly, then you do get a bit of a weakness in share price. You've had some brokers come out today issuing their first sort of statement on the stock saying that underperform is the most likely rating, giving fairly cautious price targets. But you've had a warning last week from TSMC about chip making and demand being weak there. So that's really given the short-term investors a reason to sell, and that's why you've seen momentum turn lower. As you say, it's still above the IPO price, but perhaps not quite the big continued rally that the bookmakers were hoping for when they listed on Thursday.
Quite so. And briefly, Chris, we've got quite a few retailers updating the market this week, including Kingfisher and Next.
Yes, from a sway of the UK economy. So that's, again, interesting to see how well consumer spending is holding up. And that will be viewed, I think, in the light of the UK inflation data and the Bank of England decision. I think there's a lot of comment from retailers that's going to interest markets over the next few months about whether the UK consumer can keep up its end of the bargain, really, in terms of spending and supporting the economy.
All right, Chris, we've got to leave it there. Good to catch up with you this afternoon. Thanks very much indeed.
Thank you.
That's it from me. I'm back again at 11:30 tomorrow morning when my guests are going to include the Chief Executive of Allied Irish Bank. So do tune in if you have any interest in the Irish economy. Lots of you over in Ireland watching, I know for sure. Mark Austin's up next. Do stay tuned for that. He'll have all the latest on the Russell Brand story. See you tomorrow. Cheerio.